If your goal is to pay off your mortgage as fast as possible and you would scouring the internet looking for every single strategy possible, look no further. You have found the answer in this video. Hey everyone, welcome to this video. I'm Daniel Rondberg and I am extremely excited to make this video this morning. I have a very special guest, Ron Bork, with me, and I have literally been just not only extremely excited, but I just couldn't wait to get to this because I really truly believe that this information in this video is one of the most valuable things I could share with somebody who's trying to prepare for retirement, to improve their life, to get ahead financially. And Ron has been a mentor of mine and a colleague of mine. I've done a tremendous amount of work with Ron. He's one of my personal mortgage brokers, and he has a strategy that is life-changing. And I'm on a mission to help people to realize how they can use the strategy in their own life. And the goal of this video is that we can share with you in a brief amount of time how you can take advantage of the strategy and why it could be the game changer that you're looking for. So Ron, thank you so much for making time and joining me, man. I'm glad you're here.
Hey, it's my pleasure, Danny, and thanks for the invite. And I feel the same way that you do. Like, I call it a mission. I joke about it and saying I'm on a mission from God, but because it's really it's a problem in this country how so many people reach retirement age and they don't find themselves in a comfortable situation where they feel comfortable in taking that next step. And personally, I think the 30-year fixed rate mortgage is a big part of the blame. And my strategy revolves around getting out of the 30-year fixed rate and doing something better.
It's incredible. Now, I purposely asked Ron to skip a lot of the background and all kinds of stuff. He is an incredible seasoned veteran in the mortgage industry. I do want to go into a little bit of your story, but I want to keep it brief so we can get into the meat of this because there's so much great information to share. And I like that you said it's a mission from God because, we're here to serve. We're here to help people. And this is so life-changing. This is the mortgage that I own and how I will own every single property for the rest of my life. And so it's crucial that we get this information out. But Ron, how did you get started in helping people with first lien HELOCs? Give us that background a little bit, please, if you don't mind.
All right. Just basically in a nutshell, I've been in this business for about almost 40 years now. And I always tried to do something to differentiate myself. And it was really about in the 1990s where I realized that, I'm constantly helping people get into debt. What if I took an opposite kind of approach and then also figured out ways to help them get out of that debt? Right? Because when you sign up for a 30-year loan, you look at how long that's actually going to take. I mean, you're looking at half of your working life at least, right? That's just too long. And this is what people sign up for because, it's a fixed rate, it feels nice and safe. So I started doing a lot of research and I looked into different payment strategies. One I called a precise principal prepayment strategy. But then, I came across HELOCs. Home equity lines of credit. And because they are built like a credit card, revolving credit, it's much easier to pay those things off fast because you could push all your income into there, knowing that you can have it back if you need it. Also, like you could just put it in temporarily because while funds are sitting in that line of credit, it's reducing the interest cost. And the more we reduce our interest cost, the faster we get to pay it off. And it becomes like a snowballing effect. So for many, many years, I was teaching what we call, I wasn't teaching, I was putting people into what we call piggyback loans, where we had a regular first mortgage and then a second position HELOC. That's the type of HELOC that most people are aware of. And we would use that second position HELOC, pull out $10,000 or $20,000 out of there, put it into the first mortgage, pump all your regular income through that second position HELOC to pay it off quickly. And then we would just do that again and again and again. That's now called mortgage cycling, I think some people call that, or mortgage chunking. The problem with that strategy is second position HELOCs aren't very good for us because if there's a problem with the real estate industry, what we have seen, and we saw it back in 2009 and 2010, that these second lien HELOC lenders would freeze the draw on us. It actually happened to me. And that basically told me, I can't do this. I can't continue to teach this strategy because you know what? They do it at the worst possible time.
Right.
In 2010, my income had fallen about gosh, 80%, because my wife and I owned a mortgage company, and boom, it came to a screeching halt back then. And I was totally stuck in the mortgage that I had. I couldn't do anything. I couldn't refinance. I couldn't qualify for the size of the loans that we had. And then Citibank, who had my second position HELOC at that time, froze the draw just exactly when I needed it most. Well, let's fast forward to 2014. I was working for a pretty progressive bank at that point in time, and they rolled out a first lien HELOC. Well, gosh, that changed my entire everything, really. It's changed my life since that happened, because I immediately recognized being in first position is completely different than being in second position. From a lender standpoint, the risk doesn't drop by half, it drops by 90%. And so, my company has had a first lien position loan program, that the company I'm with now, since 2005. They've never frozen a single draw because they're in first position. So utilizing a first position HELOC, where you could pump in all your money, pump through that system, get it through that loan, reduce the interest costs. My typical, or I should say average customer, pays off their loan in 7.3 years. That's compared to a 30-year fixed. It's just an incredible life-changing strategy. It's worked for me. As a matter of fact, I just will say this, as of not this past Friday, the Friday before that, I paid off my loan to zero. I never would have been able to do that with a regular mortgage, Danny. Never.
Congratulations. That's awesome.
I shouldn't say never, but it would have taken me way, way longer.
A lot longer. Well, Ron, I'm so glad you touched on that second strategy, because I want to get to that and how that's an alternative to this. But one thing I want to add before we dive in, and why I think this is so important for people to get, is I'm not a mortgage broker. People ask me all the time, like, Daniel, why do you spend so much time educating, talking, working on mortgages? And I don't get compensated in any way for any type of loan or product whatsoever. But I'm a believer in it because it makes such a meaningful difference for my clients. I focus on how to help people prepare and enter retirement with optimal cash flow, and how to have a successful retirement with the right amount of income. There's only two ways to improve cash flow. You either have to increase income from distribution of assets, or you have to decrease monthly obligations from the liabilities. And that's why I spend so much time on mortgages, because outside of health insurance, the mortgage for most people is the biggest barrier to their retirement. It's the thing that we've been taught to pay off. And then now we've formed two different camps. And this is why I want this video so badly, because you have this one camp that says you got to pay off your home as soon as possible, right? We're not going to name any financial gurus, but you know who falls in that camp. Got another group, more of the entrepreneurial side, that says never pay off debt, never pay off your mortgage. It's the worst use for money, always leverage, always put money into other things that would make more return. And people get stuck. They get like in this void of like, but nobody brings up this strategy. That's what frustrates me so much, is they're missing the whole point. First of all, it's about getting mission focused for what you want to have happen in your life. But second of all, if you leave this part of the conversation off the table, the whole thing's irrelevant, because this is the solution for both camps. And they don't even, a lot of times, and I'm not trying to sound arrogant, but it's almost like they either don't know or don't realize the power of this. Yeah. So that's why I want to take the next rest of this video to go into the strategy and really get people to see clearly why this is a game changer, life-changing, and why we're both on a mission to help raise awareness, because this could be the difference between retirement, doing things you want to do more effectively. It can be an accelerator towards your goals, which gets me very excited, as you can tell. So that's why I think this is so crucial. And it's also very pertinent for what's happening right now in this rising interest rate environment. So Ron, if you can help everyone understand and help me hear it again, what is the first HELOC strategy and why does it work so well?
All right. So first off, let me just, I want to congratulate you because what's so interesting when we talk to financial advisors, they do not bring up debt strategies whatsoever, right? They're focused on assets. They may talk a little bit about bringing down your monthly expenses in some way, but they don't offer any answer unless they know me, because I do happen to deal with financial advisors, and I try to show them that the problem that most people in this country have is that we're so fixated on, when we borrow money, we want to get the lowest monthly payment. Why do we do that? Well, because we need to have money for everything else, our regular living expenses. And we want to have a savings set on the side, whether that be for emergencies, future vacations, whatever it is. And this is, of course, all outside of first, out of your monthly income. You're paying taxes. You might be putting money into a retirement fund. Now what's left over, that has to go in a myriad of different ways, right? Primarily all our obligations, monthly obligations, utilities, insurance costs, and just food, clothing, and shelter, right? And not to mention entertainment. So we have like all these buckets where our income goes to, right? And when you're about to get a new mortgage, you're thinking mainly in terms of, I need to lower that monthly payment. Well, the lower we make that monthly payment, what are we doing? All we're doing is stretching out the term. And we go into it a lot of times by thinking, oh, I'll just make extra payments as we go along. But, very few people actually really do that. And if they do that, the problem is they can't have that money back, right? If you have a regular amortizing mortgage or loan, this goes for car loans, student loans, personal loans, and specifically mortgages. When we want to pay extra money into that to accelerate ourselves on the schedule, because that's really all we're doing. We're not affecting future monthly payments. We are reducing our interest costs, but we won't actually feel that until the end. Or maybe if we refinance, which is another issue with these 30-year fixed rate mortgages. See, we never really get anywhere, because if you look at a 30-year mortgage, after 10 years, we've paid off what percentage of the term of that loan? 1/3, right? We've paid off 33% of the term of the loan, or we've been paying for 33% of the time that we have that mortgage. Yet we've only paid off about 15 to 18%
I was going to
of
say,
the principal.
Right.
And the banks know this, and they know that you're going to refinance or you're going to move and sell that property somewhere typically between 5 to 7 years. Well, we haven't done anything in that 5 to 7 year period, right?
Yeah.
So what a loan like this does for you is it does a number of different things to reduce the interest costs. First off, you can funnel all your income directly through the HELOC. Now, there's a way to do it manually and there's a way to do it automatically, and we could talk about that in a little bit. But think of it like this. If all my money flows through that line of credit, the day I make a deposit into that line of credit, I'm reducing the balance on that loan. Well, these loans are calculated on a daily interest charge. Regular mortgages are too, but they're on a set schedule. You know that if you make your mortgage payment early in the month, let's say, or even let's say the month prior, you maybe like if it's due on the 1st and you make that payment on the 25th of the month, what does it do for you? Nothing. You could make it on the 14th of the month, the day before your late charge kicks in. Does it penalize you in any way? No, as long as you're not hitting that late charge. It doesn't penalize you to pay it later, and it doesn't help you to pay it earlier. So it's almost like, why not pay it on the 14th or the 15th of the month? But with a line of credit, the sooner that money goes in, the sooner the balance drops and the sooner the interest charge drops. So we can funnel all our money through the HELOC, lowering the average daily balance. Now, when we make our payments, yes, it's going to push up that balance again somewhat. But as long as we're making more money than we spend each month, the balance drops. And you know what? It can drop fast. It really comes down to, each person's individual situation. Obviously, somebody that has, expenses of $5,000 when they make $10,000 versus somebody that has $5,000 of expenses and they make $20,000 in income, the second person is going to pay down their loan a whole lot faster. But as long as there's some extra money at the end of the month, right? So this strategy is not necessarily for people that are on a paycheck to paycheck kind of a lifestyle. I wouldn't recommend it for these people. But I like to say that if you're doing well financially, this thing can accelerate you on that schedule like mad. Like I said earlier, my average customer pays off their loan in 7.3 years. And we know this because we run a calculator for every single customer that we handle. We run them through this, and I think we'll touch on that in a moment. But ideally, what you're doing is using all your available income to either temporarily or permanently drive down the balance. We don't have to keep a side savings account, because what good is a savings account at a quarter or even 1% when you can move it into the line and reduce the interest charge by the amount that you're putting into that line. So if you have 20, 30, 50, $100,000 sitting on the sidelines, gosh, you just move it into the line, reduce the interest charge by that amount. And if you want the money back, you can have the money back. And that's the power behind the loan. It allows us to get aggressive with paying down the debt, which is what we should all be doing, but we don't, because we're so conditioned to think, no, let's get a small monthly payment and just pay it forever. That's just a fallacy, and it's not the right way to do this.
That's huge. And I appreciate you've answered so many of my questions in one. So the reason why all people don't know about it and why big banks don't offer it is you just proved it's not profitable. If somebody's paying off a loan in 7.3 years versus an amortized 30-year loan where they're paying and paying and paying interest, and then they refinance several times and start that process over, why would a bank educate people on this when they could make way more money over someone's lifetime value of a customer if they keep refinancing and just paying through that front-loaded amortized interest forever? Is that correct?
Yeah. What's interesting about it is that, like, people in the business, realtors and loan officers, because they work with regular mortgages all the time, they are actually more conditioned than the general public to think that the 30-year fixed is the way to go. It's happened often where I'll speak to a realtor and, they just, some of them will be like, oh my gosh, that's great. But then others are like, no, 30-year fix is safe. Yeah. Well, the 30-year fix is not safe. And let me explain that just really quickly. In 2009, 2010, with the Great Recession and the credit implosion, so many people lost their jobs. Well, if you lose your job, but you're obligated to that mortgage payment, what choices do you have? So what thousands or hundreds of thousands or maybe millions of people did back then is they'd call their lender and they say, look, can you help me? I lost my job. Can you lower my payment just temporarily? Yeah. And these banks, personally, I think this should have been criminal, but what they did was they would just say to their customer, they'd say, but you're current on your mortgage. What you're asking for is us to modify your loan. But if you're current on your mortgage, why would we modify it? You're doing okay. Right. Well, no, I'm not doing okay. I lost my job. Right. They literally forced people to go past due on their mortgages just to talk to them about modifying their loan. That's just really, really bad. See, the 30-year fix gives you no options if you run into financial difficulties. If you get a cut in pay, you lose your job, you get sick, injured, go to hospital, any of these things, it doesn't account for that. When you have a line of credit, you can kick it all the way back. Some lines of credit don't even force you to make a monthly payment. There's an interest charge each month that gets dropped onto the balance. So your balance would be increasing if you're no longer putting in income. But on a temporary basis, having a mortgage like this can be a godsend. And I can tell you that I just wish that I had this loan back in 2009, 2010, when my wife and I owned a mortgage company and our income fell like crazy. We had no options, we became unmortgageable, so we could not get a refinance. Had I had a loan like this, I can't tell you the amount of stress it would have eliminated. Yeah, it's huge. All right, I want to go over a couple of things, and then I want to dive into a simulation. So first of all, I want to tell you my personal story, and you know this, because when we first started talking, I came to you and you had, and I called I think I called 15 or 20 pretty well-known, prominent mortgage brokers and real estate agents in town here in Arizona. None of them had heard of the strategy. All of them were skeptical. And by the end of each conversation, they all were asking me where they could get more information about it. So, the people that were in charge of my community that I was looking to for this education, I was now sharing this information with them. And I'll tell you, when I had started my first business, my first lien HELOC was very helpful to me personally, because when you start a business, you need a lot of cash flow. You need to be putting cash in. And so it was helpful for me to have that flexibility to be able to utilize the money I'd already paid in and have access. Now, that's not the recommended strategy, but if you have a season of your life that is challenging cash flow wise like that, and you need to maneuver, it was extremely helpful. I couldn't have done it without that first lien HELOC, the first one you set me up with. Yeah. And so I think that's a really personal account to my story and connection with this strategy. But a couple of things I want to touch on before we dive into a simulation. So it's for people who have positive cash flow, a certain credit score. What's the criteria for the credit score? 700.
They have to have equity in their home. And I would add, like you said, they have to be pretty financially disciplined. They got to be somebody who can consistently operate something without, constantly borrowing from it, because it's still leverage. It can work both ways. It can be amazing and accelerate, but if you use it improperly, it can have an adverse effect, like any loan or leverage can do, from my understanding. But I think the main thing that I want to touch on before we dive into simulation is you talked about it. You're changing the mortgage interest calculation. You're going from an average percentage rate to a average daily balance. And I feel like there's a lot of secret sauce in there that helps people it's kind of confusing at first, but then when you explain it through the simulation, we'll go through it. But that's one thing that I think is so important for people to understand is they're going, well, why would I refinance? It's higher rates. And I think what's hard for people to grasp is to me, and correct me if I'm wrong here, but it seems like it's less about interest rate and payment and more about time and balance reduction.
That's 100%, Danny. And look, this is what we are always thinking about. We're thinking about how can we reduce that monthly payment? And the way we do that is by extending the term. But the longer we extend the term, the more interest we're going to pay. I've read things that we pay the average US citizen over their lifetime of income, 30%, as much as 30% goes out to interest charges. And so, most people, this is just ingrained. They think, they look at a mortgage almost like it's rent. It's a necessary evil. I have to do it, But the shame of it is when you look at a monthly payment on a regular mortgage, 12% maybe of that monthly payment might be going to pay down principal. At these rates where we're at now, it might even be a little bit less than that. It's a tiny portion. Most of it is just interest. And if you could look at it like, I like to say that when you look at a mortgage payment, you look at, and even just buying a home, what is the cost? What is the investment? The investment is when you put a down payment down and when you pay principal on your mortgage payment. But as I just said, right, the principal portion is so small. So really on a regular mortgage, almost most of it is just a cost. But when you flip the script, so to speak, and you jump into a loan like this, where you can really aggressively pay down this debt, move money that you got sitting idle. I mean, think about it. When your money sits in a checking account, is it working for you at all? No. Is it working for the bank? Yeah, because they could use that money, right? Yeah. If they have money sitting in there, that's part of their reserves. They could loan it out. They could do whatever they want with that money. Now it's a demand deposit. And when you ask for that money, they have to give it to you. But the fact is, these checking accounts are not helpful. Savings accounts are not helpful. Their rate of return is dismal, right? But when you look at whatever you're paying on this mortgage, if you move money into that, let's just take somebody that's got 50,000 sitting in a savings account. Well, what's it getting them? 0.5%, 1%. I move it in there. If I'm paying 6.5% or 7% or 7.5%, whatever it may be, immediately I'm not paying interest on that portion. So you could say that's equivalent to getting that amount of interest, right? If I'm saving it, it's the same as getting it. It's actually even better because if I'm getting it, now I have to pay income taxes on that money. But if I'm saving it, I'm just saving it. And that's so much better. If we could just eliminate debt. And when you have this, after a while, you build up enough credit. If you're carrying any other debts, you just pay them off with this loan. So ultimately, this becomes your home, becomes your bank. You no longer have to go to a bank to get a loan, even if you want to buy a car or anything else, because if this is better than a regular mortgage, which it is, it's also better than a regular car loan. It's better than a student loan, unless the student loan, of course, gets forgiven. So be careful of that. But ultimately, when you have a loan like this, you get flexibility. You can aggressively pay down that debt so that we're literally reducing interest costs by 50 to 70%. It is that extreme. We can
and I'll add this, and I think when you use it correctly, one of the things that I absolutely love about this is you're building liquidity. You're building so much more liquidity with this strategy than a regular mortgage. We're going to show that in a second. I want you to show that simulation we were going through because I think it's important for people to get a visual. But let me just ask you if you agree with this, and then we'll dive into simulation. Let me just correct me if I'm wrong on this statement, but tell me if you agree with this. So I feel like it literally makes you when you do it correctly, okay, it makes you as efficient as possible with every dollar you make if you do it automatically all the time. And if you don't have it in your life, I feel like it's actually realistically impossible to fully optimize your finance to be as efficient as possible for you. Do you agree with that statement?
100%. It optimizes you. It makes you more efficient. What you find out, like once you can get rid of all other debts, it literally simplifies your financial life, because now, like, all right, so we're still going to use a credit card. We're going to use a credit card for our everyday expenses, right? I use a credit card for pretty much everything. I hardly ever carry cash.
Yeah.
And so at the end of the month, I have two statements to look at. I've got my line of credit statement and I've got my credit card. I can immediately see what I'm spending every single month. And this is motivating. When you're tracking, it's a faster road to improvement is when you're tracking something, right? And so with having a loan like this, it literally enables you to look at each month on its own, and you can see where your money is going out. And you can see how much money can be sitting in that line of credit, because you know it's working for you. Because the lower your interest charges each month, the faster you're going to pay this thing off. And so it's really like a snowballing effect. It starts out a little bit slower, and as you go, it gets faster and faster and faster. So it's really, really powerful. Okay, so my company has created this, they call it a simulator. It's basically a calculator of sorts. And this allows anybody to just come onto this website. It doesn't even require a registration. We literally want people to see what this loan can do for them. So it's at allinOneLoan.com. And then when you get there, you click right here, calculate savings, and then you click get started and start a new simulation. Now, Danny and I, we put in some numbers earlier on just so that we wouldn't have to fumble through this. So we're going to start showing you. But I basically did a comparison of what if we compared this, getting this loan versus a new loan. We have a $500,000 home value, a $350 balance. Obviously, we could have gone to 400 or even 450, but let's go with 350. We're using an interest rate of 6.5%. That's our monthly payment. And then we can just go to deposits or click next. Now, we created an individual that gets $7,500 net. Remember, this is based on your net take home pay, not your gross. Okay. So you want to look at your pay stub, or, you know, if you're fluctuating income in any way, like commissions or self-employment, you're going to have to use an average of what you get. So you're going to put in your repeating deposit, and then you're going to choose how often does it repeat. So in this case, we have a bi-weekly. And we just figured, okay, this guy's got $30,000 sitting in a savings account somewhere doing nothing for them. And so we're going to have a one-time deposit. In month 2, we're going to move this $30,000 over there. So you can see, based on this gentleman's income, or this lady, we have average monthly deposits of $16,000. Average annual is $195. Now, if you have a regular mortgage, obviously, you're not putting $195,000 into your regular mortgage. But again, with this loan, you can, because it's a line of credit. You can always have it back. So we're going to click next here. And by the way, you can add repeating deposits down here, and you could add other one-time deposits. If you know you're going to get some cash in the future that you can move into this loan, you can account for it right there. Then you
so I had asked Ron to run through an average example of like an average loan to get these numbers. But Ron, one thing I want to point out is, this isn't like some tool that only you have access to.
Right.
Like this is on the website. Anybody could go on there and walk through this, and then figure out their scenario after this.
Yeah. And as I said, it doesn't even require a registration. So we're not even using it as marketing. This is strictly to let people see what they can, what they can do, what kind of results they can get.
I like that.
Now, the important part of this is taxes and insurance. It'll use a default based on the value of the property. So if you want to change this here, you could just change it. And we're accounting for the traditional mortgage payment already, because we're comparing for that. We're comparing it against that. And then we have other monthly expenses at $10,000, $125. And we have put in here how much our percentage is left over. So you want to think about, at the end of the month, how much is left, right? How much can you put into a savings account? How much, expendable money is left over at the end of the month after you've paid all your other expenses? And we can play around with this. Because once we put in this 20% here, we're seeing, okay, there's $3,250 left at the end of the month. So now we just click on results. And here we see, this is the traditional mortgage. It's going to take you 30 years. You're going to pay $796,000. Isn't that interesting? I mean, $350,000 is what you're borrowing, and you're going to pay back that $350 plus $350 in interest, plus another almost $100,000 in interest. So you're winding up with a bill of $796,000. That's if you get the whole 30 years, that you're actually paying it for all 30 years. But you know what? You're not. You're going to sell the house, or you're going to refinance before this time comes up. And guess what? That's only going to increase your total expense. So this is actually, that's optimistic, Danny, right? That almost
Right.
800,000 on a 350 loan. That's actually optimistic, because we know very, very few people are actually going to go through that. They're going to increase this. Now compare that to our loan here, where we said we had 20% of our income is left over. Look at the total interest that we're dropping from $446,000 to $67,000 in interest.
That's the difference right there.
360 payments, 71 payments. It's just 6 years. And we're going to save $380,000 doing that. Now, there are some rates and assumptions that we chose here. This will change if I say that the rate trend will remain at the initial interest rate. So we just change that, and we're going to click on results. And you see, even at today's elevated rates, and they are elevated because only the short-term interest rates are high, the 10-year Treasury bond is still sitting at about 3.5%. 1 year is about 4.7. We know that relationship is going to go back to normal. Right now, we have what's called the inverted yield curve, and this is all based on what the Fed has been doing over the past year. And so we have a very elevated short-term interest rate market, and this is tied to a short-term interest rate. It's tied to the 1-year Treasury bill. So right now we have elevated, and if it stays high like this, it'll take a little bit longer to pay it. But you could see it's not about the interest rate. Just like Danny mentioned earlier, it's not the interest rate. It's how fast you pay something off. So it's really, I just find it to be kind of incredible here. We can also do like your initial rate plus 2%. If you think interest rates are going to go higher from here, which, I know the Fed is going to increase like in a couple of days. Well, I think tomorrow. They'll probably increase it another 0.25%. But interestingly, the last time they raised it 0.25%, the 1-year Treasury actually went down a little bit. So we all know that we're getting near the end of these hikes. And at some point, it may happen this year, it may happen next year, but the Fed will reverse course. But even at these interest rates, look at that. I mean, we just raised the interest rates a lot, and you're still paying it off in less than 7 years.
You raised that interest rate 2%, and it only added a couple months.
That's it. It's incredible, because it's certainly not at all about the rate. It's about how much can go in here. So let's say we were a little aggressive on this, and let's say there's less money left over. There's only $2,500 left over here, $2,437. Calculate these results. Look at the difference. Okay, it goes up some, but you're still saving almost $300,000 in interest expenses. I mean, this stuff is really, really powerful. And I just feel like everybody in the country should run this. Everybody that has a mortgage or wants a mortgage should run this calculator and see it for themselves. Is this a good time to introduce how they can get in touch with me?
I will do that. Yeah, I want to say a couple of things. So to your point there, how could you make a good decision without having all the information on something like this? And again, I don't want anyone to feel I don't have anything to do with mortgages. I don't endorse mortgage strategies. I don't advise on mortgages. I don't get compensated mortgages. I want to make that really clear. But you can see how life-changing this is. That's why we're making the video. It's right here. It's like people just don't have all the information. And where my heart is in this is like, one, I love that we're doing this in a high interest rate environment, which is incredible to show the power of this, even with rates the highest they've been, not historically, but comparatively to the last 10 years. And then, my heart is really in this because I have people I sit with every day who are delaying retirement at a job they hate because they have to pay off the mortgage before they retire, or they can't retire without paying off the mortgage. And so because it's such a large portion of their income that goes to the mortgage. And so that's why I bring on professionals like Ron, who can make this meaningful difference in people's lives. This is the difference maker. And that's why I think it's important. So yeah, Ron, if people need more information, they need someone to help them with it, they need to walk through this, they want to run their scenario, they have questions, how do they get in touch with you?
Right. So before I answer that, I just want to make a point about that. It's interesting. Ever since I started really concentrating on this this strategy and this loan, I pay a lot of attention to the type of people that contact me. I have not done any marketing. Everything I do has been personal referrals, whether it be from financial advisors or whatnot. And I find that my average customer is probably, I would say, in their early 50s. If I had to aggregate all my customers, they're in their early 50s. And I find that really interesting because when I hit 50, it was kind of like an awakening. It was like, you know what? Gosh, I'm not even that far away from retirement. And so I think what happens is a lot of people, when they hit their 50s, they start thinking in those terms, like, what do I got to do? And they start looking for answers. And then they go online and might see something about first lien HELOCs, maybe not. And if you never saw anything about it, you got to thank Danny for bringing this to your attention, because people need to know. All right. Whether or not you actually do this yourself, that's going to be up to you. But banks are not telling people about this. Loan officers are not telling people about this. Quite frankly, I'll be straight up. I make less money, quite a bit less commission when I do this loan. If I do a regular mortgage in comparison to this, I'm going to get 50% more commission. Whoa. So it also takes quite a bit of explaining, right? So you got all these loan officers, thousands and thousands of loan officers, and you give them access to this loan. What most of them will do is they'll think, wait a minute, I'm going to make less money and I got to explain all this stuff. I'll just sell a 30-year fixed. So they're just perpetuating the myth that the 30-year fixed is the smart way to go. It really isn't. So number one, I mentioned, you can go straight to this calculator. It's at allinOneLoan.com, and then just click on calculate savings. And you can mess around with this, play around with it. You can't break it. You can come back. You can make changes. You can come to any one of these tabs, make changes, and play with it to your heart's content. But if you'd like to do it with me, or you want to talk to me about this loan and how it can benefit you, I keep my online scheduler is at www.ronbork.info. So it's RONBORK.info, INFO. And you could just book a call with me there. It'll ask you a few questions so that we can hit the ground running when we connect, and I'll have an idea of your personal situation. And, we could jump right into this calculator. We could talk about your questions, anything that you choose to do. My thing is, I just want to let people know about this. People need to know. And quite frankly, I think that if the majority of this country, the homeowners in this country, if the majority had this loan back in 2008, 2009, 2010, when it felt like the world was falling apart, it would not have been the same. It would have been completely different. But these 30-year fixed that people got, are in these obligations with no change, no ability to make any changes to that. That's really detrimental to them. And so now they have to go and this is why so many people did short sales. They were forced to sell their property back then because they couldn't make the payments. The bank wouldn't modify the payment for them. So they ruined their credit. They went to short sale. They lost money on the property. If they could have just held on, right? Well, a loan like this enables you to hold on if you ever go through a bad period. But even stronger than that is if you never go through a bad period, you're going to be done with your mortgage in a fraction of the time, and then have years and years and years of having available credit that you could use at your disposal. So if you know how to leverage it, these people that talk about not having a mortgage or keeping a mortgage and you should have a mortgage, those guys, well, they're looking at it from a very entrepreneurial standpoint, because it's true. If you could borrow money and use that money to make more money, that's a wonderful thing. But most people aren't of that breed, right? Most people are just living their daily lives. They want to have a job and then come home and relax. So they're not doing those things. They're not necessarily leveraging. Those people need to get out of debt. The people that do want to leverage their debt, this is the perfect mortgage. If you're an entrepreneur, self-employed, anything like that, get this loan, pay it down fast. Now you can have hundreds of thousands of dollars of available credit at your disposal, and nobody's ever going to say, hey, what did you write that check for? Or you don't have to get pre-approved for anything. It's automatic. It's at your disposal.
Yeah. So well said. So powerful. We're going to put those links down in the description. If you found this video valuable, and Ron, thank you so much for joining us. I'm so grateful you took time to do this. I think it's really
My
impactful.
pleasure.
If you found this information really helpful, please just take a moment. All I ask is that you like the video. It really does help me reach more people to share this message. Please also just take one moment and subscribe, because you'll be able to get access to more videos like this. I'm really committed to bringing as much value as I can to make a meaningful difference in people's lives so they can have a more fulfilled retirement. And then please share this with someone who you think could benefit from this information. Also, I'll just ask one last thing. Please leave a comment. Any questions you have, Ron and I will be looking in the comments. I'll ping Ron. We'll get the answers to every single comment to make sure people get all their questions addressed. And we just want to say thank you so much for joining us. Reach out to Ron. We'll see you in the next video.